The recent decision by the U.S. Commerce Department to broaden its tariffs on steel and aluminum imports is stirring up significant concerns about global trade dynamics. This move, which was announced last week, extends the existing 50% tariffs to include hundreds of additional products that contain steel and aluminum, thereby amplifying risks within global supply chains. Starting Monday, this expansion adds 407 new product codes to the harmonized tariff schedule, meaning that a wide array of goods will now incur tariffs based on their steel and aluminum content. Furthermore, any non-metal components in these products will also be taxed according to the established tariff rates for goods originating from specific countries. This latest tariff increase, which saw rates jump from 25% to 50% in June, is yet another example of the U.S. taking unilateral action in its trade policy. According to Show Me, a senior research fellow at the Chinese Academy of International Trade and Economic Cooperation, this shift is likely to contribute to increasing instability in global markets. The repercussions of these expanded tariffs are expected to ripple through various sectors in the U.S., particularly in industries such as automotive, construction, and manufacturing. Companies that depend on imported steel and aluminum components may find themselves facing higher costs, which could ultimately lead to increased prices for consumers. The automotive industry, for instance, has already been grappling with significant cost hikes since June. Major manufacturers like Ford and Molson Coors have reported multi-million-dollar increases in expenses due to the tariffs, which have driven up aluminum prices. Deere Company has also revised its forecast for tariff-related costs for the fiscal year, now estimating them to reach $600 million, a rise from the previous $500 million. In the consumer goods sector, the impact is equally pronounced. AriZona Beverages, famous for its 99-cent iced tea, may soon have to raise its prices as a direct result of the increased tariffs on aluminum. Despite the fact that 80% of its canned sheet metal is sourced from recycled U.S. beverage cans, the company faces tariffs on 100% of its aluminum, which totals over 45,000 tons annually, with 20% of that imported from Canada. Joe emphasizes that with few domestic alternatives available, U.S. businesses and consumers remain heavily reliant on imports. He warns that the higher tariffs are likely to escalate costs, squeeze profit margins, and diminish competitiveness in the marketplace. This tariff expansion has also sparked worries among U.S. trading partners who may contemplate retaliatory actions in response. For example, Canada, which accounted for a staggering 70% of U.S. aluminum imports last year, retaliated in March by imposing 25% counter-tariffs on $21 billion worth of U.S. goods. Canada has consistently signaled its intent to consider further retaliatory measures as trade tensions continue to rise between the two nations. In South Korea, the government has announced initiatives to assist small and medium-sized enterprises that will be affected by these expanded tariffs. The Ministry of Trade, Industry, and Energy stated on Monday that it plans to significantly enhance consulting services, including verifying the steel and aluminum content and certificates of origin, while also substantially reducing the financial burden on companies. Zhou cautions that frequent changes to tariffs could undermine the reliability of U.S. trade relations. He notes that even if American buyers are willing to absorb the increased costs, foreign suppliers may become more hesitant, which could lead to a reduction in imports and further exacerbate inflationary pressures in the U.S. market. But here's where it gets controversial. Are these tariffs truly protecting American industries? Or are they setting the stage for a trade war that could hurt consumers and businesses alike? What do you think? Are these measures justified, or do they risk destabilizing the economy? Share your thoughts in the comments.